Yep. So in this video, I'm going to be covering something pretty important. We'll close this for now. It'll be back within a second. Um, you can see things like this, and we'll be covering risk aversion and what that is and how that affects the market, right? Last time I covered central bank policy and some things that would affect that and how that affects the currency essentially. I hope you got that video. If you didn't, make sure you ask questions because you won't get it if you don't ask questions. Um, now you need to know like what um how does the money flow, like when investors are moving their money using this thing that I'm getting ready to explain to you called risk aversion, um risk on risk off indicators, in other words. Where does the money flow? Because if you don't know where the money is flowing in the market, as in like the big players, central banks, hedge funds, investors, and things like that, you're not going to know. So if, in context with the last video, these all the actions that a central bank can take, and then all of the things that affect the, all some of the example reports that were the big ones that I gave you that would affect the central bank stuff, policy and things like that, and move the currency. All those things are going to be indicate and cause either risk on and risk off indicators depending on what's happening. So let me explain to you so you have a little bit more context, right? But I just had to say that before I started the video so that you had a bit of context from the last video. Risk aversion refers to when traders unload their positions on higher yielding assets and move their funds in favor of safe haven currencies, which you'll find out during this video what they are. This normally happens in times of uncertainty and high volatility, a so-called risk off environment. So that first paragraph right there, risk off. In turn, and we'll give it in more detail. It's this there's more down below us. In turn, periods of perceived low financial risk encourage investors to take risk, therefore creating a risk on situation. The following instruments are excellent barometers of market risk sentiment that can indicate higher or lower risk taking depending on their performance. When I say higher and lower risk taking, they either mean this first paragraph or this second sentence right here. Um, one of the two, right? So this is risk on, or my bad, risk off, and this is risk, the definition of risk on. So let's go find out what those risk sensitive currencies are, right? There are certain currencies that are sensitive to the risk on, risk off indicators. So scrolling down. And I've done this video before, but I wanted to do it in more great detail and in context with the last video so that people really kind of piece some things together. These are some pairs that are going to be, aside from Forex, that are going to be affected by that. And I'll cover a few main ones that people like to trade these days. First of all, gold and silver, right? Obviously, XAU, USD gold, and then silver. Some people like to trade as well. A contracting economy, so anything having to do with dropping GDP, things like that, that are PMIs contracting, manufacturing PMIs and things like that contracting, are going to be like, for example, like consumer confidence and things like that, going down like the euro had earlier overnight and things like that. That's all going to be contract. It's not a contracting economy. A contracting economy usually decreases the industrial demand for silver. While gold tends to keep its value as a monetary asset, the reason is that silver functions mainly as an industrial metal, while gold serves as a hedge against economic and political uncertainty. I want you to take that first one because we're going to break it down pretty slowly on purpose and really, really study that and what that means. As a result, and then that's in context to with and gold, if you haven't gathered, is a safe haven demand. Risk on if ratio is down, risk off if ratio is up. Gold is a safe one of the safe haven assets that investors like to flock to. And I'll show you that in a second. As a result, this ratio normally goes up during risk aversion and falls off during times of risk appetite. A rising ratio means gold is outperforming silver, and a falling ratio means silver is favored. So a rising ratio means that investors move their money to gold. And when that is not the case, they move their money to silver, between the two of them at least, during the risk on and risk off. So because this is just like them saying the same thing up here, but they're just using a bit different terminology. But just know that that does mean exactly what you read up here. Everything that you're going to read down here. So as a result, of risk on, they are going to be moving into gold. And when it risk off, they'll be moving into silver. And then in turn, gold will be dropping. And we'll get a little bit more detailed. And this ratio is about to turn where was I at? Yeah, exactly. When this ratio is about to turn from a bottom, traders are expect risky assets to fall. When silver almost is gold and the ratio starts to slip, the market's appetite risk grows. So you have to make sure you notate all of that in this. And I'll reference this article as well, or you can just take this as you're looking at this link and type it into your browser as you're looking at it and go to this exact one. US 30, risk on if utilities are down, risk off if utilities are up. Dow Jones Utilities average comprises the Dow Jones Utilities average comprises 15 utility stocks drawn from electric, gas pipelines, um, telephone companies, and so forth. A rising utility stock prices indicates investors are anticipating falling interest rates, right? So currently, what are we in a phase of? Everyone's speculating and seeing evidence, and also that last dovish speech by the Fed that there's going to be falling interest rates, right? So that means right now, right, stocks under the Dow would be going up, and the Dow itself. Let's go check that out. Also gold, while we're at it, so I don't skip that one. So you could see gold obviously appreciating during these times of uncertainty, and we'll get why. Because if you remember, the dollar and gold have an opposite correlation. When dollar goes down, goes up, and vice versa. Let's go to currency strength. That's actually the wrong one. My bad. Just straight currency strength. Where's the dollar today? Way down here at negative 22, the loser for the day. So for the day, the dollar is down and gold is doing what? Appreciating. So yes, we could have traded gold today, but I surely did not want to given the fundamentals that are getting ready to develop for the US dollar. I need to see more solidified evidence of the Fed actually getting ready to cut. This right here, if you look overall, is a range. They're building liquidity to wait for what happens. There's really no such thing as a range. It's more of if it's ranging like this and it goes into a range, it's just building up liquidity. You have buy side liquidity here and sell side liquidity here. The sell side was swept last. They try to go long, but we're not able to break this high right here, and they haven't been able to, and they've been kind of ranging in this general area right here. But overall, we are bullish. There was bullish opportunity. Yeah, this imbalance field right here. You had this imbalance field right here, and now we're going up, and this is the daily time frame, by the way. So as said, so that means that right now, right, what is the current market right now? Uncertainty. There's uncertainty right now. So that's why they're moving over to gold, and that's why gold's appreciating. Another thing that affects gold is geopolitics war. So whenever there's a worsening development for geopolitics, like more progression towards war, less peace talks, things like that, that also they have inflows into gold. As when they move their money, and this causes that appreciation, as you see. So somebody could have dropped down to the 15-minute, right, today from the 4 hour in the daily and caught a nice long several times in these areas on gold just based off of risk appetite alone. And also, I'm going to need you to write down these currencies that are risk sensitive because they are the easiest currencies to trade once you do get this whole risk on, risk off thing. You can type this in and literally use this as a guide and template and refer to this as many times as you need to while you trade. So gold, US 30 for traded so far. So since the stocks are going to be doing well, right, during times of perceived cuts, it's the same thing. Times of perceived cuts are going to be outflowing out of the UST because obviously if the UST is going to be falling, investors are going to inflow into other currencies. Let's go US 30 and just take a view of that in comparison to what I'm actually saying. Sure. Let's go to a higher time frame for more context, but you can see right here how long this has been, even just in recent time, right? And then what does this say? The Dow Jones has 15 stocks under it. Various, different industries are rising utility stock prices indicates investors are anticipating falling interest rates. Right now, we are anticipating what in the US? Falling interest rates, interest rate cuts, as we have been discussing. Right now, what is the Dow doing? Appreciating. So somebody could have during any of these sessions really taken this long right here that happened. It could have taken this long right here that happened. If they were in on it, they could have taken this long up right here that happened. All of these long opportunities, let's just say on the 1 hour. If you're going for 1 to 2, that's plenty right there. 1 to 2 right here easily, 1 to 2 right here easily. And you could have just waited for the trend to continue on. And what did it sweep last on the 1 hour? Sell side liquidity right here in this area. Very easy, right? So that's a Dow. That's because the utilities are big borrowers and their profits are enhanced by the lower interest cost. Conversely, the utility average tends, excuse me, tends to decline when investors expect rising interest rates. So, in contrast to interest rates cutting and interest rate hiking, the Dow Jones is specifically affected by those for these reasons. Because of this interest rate sensitivity, the Dow Jones has, utility tends to outperform in periods of pessimism and deflationary expectations like we have now, unless other data proves otherwise, aka inflation going down, and severely underperformed during periods of overconfidence and bravado. That is how you trade the Dow, right? You can pay attention to um, the rates that are happening, the interest rate, and the policy path of the Fed, and determine just with this paragraph alone where the Dow is going. Now, obviously, you have other things that affect the Dow. For example, let's just say earnings for those major stocks that are coming out that are under the Dow, that affects the Dow. So if you have like a Dow going up because of we're cutting interest rates, and I'm literally teaching you the fundamentals for how to trade these pairs, by the way. Then and you have positive stocks, let's just say, positive earnings and things like that that are coming out, which is like the big one of the biggest movers for stocks is like earnings season and things like that. Then it's just a double positive when it comes to fundamentals, when it comes to the Dow. And then when the Dow appreciates, the stocks under it typically appreciate as well overall. I'm not going to be covering this because we don't trade that. NZDJPY. The Japanese yen also is a safe haven asset. So this is moving on from like gold was risk on, risk off, it flows. The Dow was interest rates and how they treat risk on, risk off flows and what affects the Dow. Obviously, if they're appreciating, then the paragraph that I just read to you a second ago is going to take effect. It's only if this, then that. If interest rates are falling, then this. If they're not, then that for direction. And that's just like the basics of of like how investors move their money and why. So now we're moving on to Forex, right? Forex pairs. So we have gold so far, and you can. I mentioned the Dow because a lot of people like to trade US 30 and things like that, but they just trade price. It's the wrong thing. It's too much volatility. You have to at least be on um the same side as fundamentals and like where investors are moving their money. So if you remember this and you don't have to remember it right away, like you can use these as a guide until you've seen it so many times that you literally have no choice but to remember it, right? It's like stuck in your brain what risk on, risk off is, what the risk sensitive currencies are, what interest rates are, why the interest rates cuts and hikes even happen, and how that affects each individual asset or currency, right? Yes, trading takes studying. I had to learn that the hard way. I thought that I could just learn price action and hop up in here, and it works for a while. But then when things start happening in the world, it doesn't work anymore. The end gives us some insight, right? So you should be writing down if you're trading just Forex, you should be trying to write it down. And then one commodity, you should be writing down XAU USD. And this is how you trade that. If you like to trade the Dow, you should be writing down that part or screenshotting it or bookmarking it, taking a screenshot of the whole page and putting it into a PDF. I don't care what you do. But make sure you're taking these notes. Actually, the notes have already been taken for you. You just have to make sure that you bookmark it for a reference. The yen gives us some, and then if there's like nothing happening, right, in the markets, like maybe no major fundamental drivers, this is going to create, the market's going to be leaning towards and looking at what type of risk environment it's currently in. And there's always a direction every day. There's never just like, oh, it's just sitting there. There's always either something fundamentally driving happening that's causing risk on, risk off market or will cause risk on, risk off market. Right now, we have a lot of central bank policy and speak things and things like that talking. Now that we have tariffs fears kind of fading away and deals being made and deals that have been made for some currencies like the yen and the euro and things like that, who in the pound, that those countries, respective countries, secure deals with the U.S. so they don't have to worry about their growth and things like that. Because if you have higher taxes on your stuff, then obviously it's going to affect your like growth and how much money you make. When I say growth, I mean GDP. How much money are you making? It's like cheaper for you to export your stuff and do business with other countries, especially the U.S. being one of the biggest economies on the planet, right? Everybody does business with us. Okay, so risk on. If NZDJPY is up for the day, Risk off if the JPY is down. Now that they changed their lingo and they're referring to risk on, risk off. Stuff about the Dow is interest rates, but it's just going to make it either risk on or risk off. The effects of the interest rate decision, and then that in turn determines direction. And then if you were like, well, what's that? Make sure you go back all the way back to the top. Oops, and then refer to the definition of risk on, risk off, and then you'll be able to put two and two together. It's also Claude and Chat GTP. They also know all of this stuff. You just have to ask the questions. Um, risk on, risk off. NZD/JPY is up, and risk off is if NZD/JPY is down. The yen gives us some insight into risk appetite rising when investors do not want to deal with risk. Okay. The problem with using USD/JPY cross is that it is subject to overall strength and weakness in the dollar. It is. Even if risk appetite stays the same, if the dollar is strengthening or weakening, USD/JPY will change. Instead, we can look. I'm learning some new stuff here too about the yen. Instead, we can look at the New Zealand dollar as a so they're saying that they're in a risk on, risk off environment. This is a tough pair to trade due to these both being risk sensitive currencies. And they said that it's better to trade NZD/JPY rather than USD/JPY because of that. Because of how the correlation of the US dollar going up or down affects the yen in terms of risk sensitivity. Whenever they're moving money, I'll have to keep reading this to tell you. I don't want to get too far ahead of myself. Instead, we can look at the New Zealand dollar as a high yielding currency, serving as a proxy for high yielding instruments, right? Proxy, it's just a hedge for high yielding instruments. New Zealand dollar and Japan have a large central bank benchmark interest rate differential, making it a popular carry trade. Therefore, the NZD and JPY pair tends to decline when risk aversion permeates the market and rise, or it tends to decline when risk aversion permeates the market and rise when the market is turning risk unfriendly. NZD is a so-called common doll, that is commodity related currency. So I actually didn't know that the New Zealand dollar was a commodity related currency, and I opened that up so we can look that up even more. So they're saying that this is more difficult to trade, even though they're both risk sensitive currencies, and because the New Zealand dollar is a commodity linked currency and not one of the safe haven assets like the dollar. I'm gonna just lay this out for you. Gold, U.S. dollar, the Japanese yen, the Swiss franc are all going to be typical and traditional safe haven assets, right? For people, investors to move their money to. And then when they actually are not doing that, then they are outflowing out of safe haven assets and into the other assets here, right? So they're during times of uncertainty, they are inflowing their money into these three as well as gold. And then when times are actually not uncertain, so risk on, risk off, like I said, then they're moving their money into, let's just take off the CAD, other currencies as so. And this is why the currencies fluctuate like this in reference to the dollar, the yen, and things like that. Where's the yen at today, for example? Still, it's up for the day, but that's only because the dollar's down for the day. It's only because, you know what I mean? Let's get back here. Um, let's look a little further about the worried about this second. So that's the logic on that. I'm gonna keep that pretty simple and then go a little deeper here as to how the New Zealand dollar is a commodity linked currency. Because I've always just known the CAD to be a commodity linked currency. So it's very interesting. NASDAQ. I used to like to trade NASDAQ. I still do every once in a while. Risk on if NASDAQ is up, risk off if NASDAQ is down. If you remember the definition of risk on, risk off, risk off is when what? Risk aversion refers to. So risk aversion, risk off, they're averting risk. They don't want to do risk. They don't want to deal with risk because they're uncertain. So this is what they do. Risk aversion refers to when traders unload their positions in high yielding assets and move their funds in favor of safe haven currencies. This normally happens in times of uncertainty and high volatility, a so-called risk off environment. Remember that definition. In turn, Periods of perceived low financial risk encourage investors to take risks, therefore creating a risk on situation. So in a risk on situation, then they are moving away from the dollar. And a risk off situation, they are moving in favor of safe haven assets, which is somewhat that I would just named. So that would make the current environment, right, a risk on situation, given that the dollar's down for only for the day at least. Today is they're very much so risk on. Nasdaq. When money is chasing or risk on if Nasdaq is up and risk off is if Nasdaq is down. Well, let's go look. Look at that big uptrend. When money is chasing return and market mood is improving, capital lenders or tenders to favor equities. My bad. As a general rule, Nasdaq flush with technology stocks tends to imply retail money, and while the S&P 500 tends to reflect institutional investment in the Dow Jones International Big Money, the allure of what is popular is hard to resist. This is why when you see Nasdaq falling, it is labeled as a risk on. Alternatively, once the fear of losing subsides, the Nasdaq tends to outperform as tech stocks may get irrationally sold. The market themes are expected to affect investors' sentiment and can be followed by clicking here. So I don't know what they have here. Well, we'll review that as well in this video. We haven't even gotten to these. These are no. I don't pay attention to these. We haven't even gotten to this paragraph, bro. This is one of my favorite paragraphs. Impacts on the forex markets very specifically. Those are a few forex pairs and why they move that way. In reference to risk on, risk off, and risk aversion, like I said, risk on, risk off, and risk aversion are all the same thing. They basically are risk aversion is when, as I had said, but risk on, risk off is just like a short, kind of like a simpler term for risk aversion. I feel like when people are, when you explain risk on, risk off, and where people move their money when these things happen, then it becomes a little easier than saying risk aversion. First and foremost, risk aversion can lead to liquidation or profit taking. Note that down. Profit taking causes selling of that asset. The process of unwinding these trades may result in a need to buy back funding currencies like the dollar. Think about that. And the yen as two safe haven assets that I just named off. When the above charts convey a sense of nervousness in the markets, risk sensitive currencies will be kept in demand. So whenever they're nervous, when they're nervous about risk, then these will be in demand because during times of uncertainty, risk sensitive currencies or safe haven assets tend to do very well in times of uncertainty. So it's actually opposite. A few years ago in 2015, the ECB announced its massive QE program, changing the dynamics for euro, big enlargement of the ECB's balance sheet and negative deposit rates send money away from the eurozone to find higher yielding, riskier assets elsewhere. The euro turned into a funding currency, not dissimilar to from the Japanese yen. In a serious risk off environment, one should see major shifts in also in the price of gold. Should gold not appreciate means that traders are not feeling their environment as dangerous, moving their money into safe haven assets. So the environment currently is not dangerous. Likewise, in times of risk aversion, we should expect pairs like NZD-JPY and AUD-JPY to fall lower because of the yen appreciating, right? They're inflowing into safe haven assets. So that would mean that these ones would be dropping. Whenever the US dollar does well, the Japanese yen does well. That's just some type of heavy fundamentals. Swiss franc does well, and gold does well. To fall lower, when that's not the case, and these JPY pairs hold up well, it suggests that there is less fear in the market than market indicators show. Oil prices. Let's see. Oil prices. You have to consider oil if you want to trade the Canadian dollar. It is commodity linked as well. Oil prices is not having much fun in a risk off environment, either which shouldn't come as much of a surprise considering global growth fears and the impact of risk are intrinsically linked to future oil demand. The Canadian dollar, especially against the Japanese yen, should be monitored in extreme risk environments. Be it risk on or off, more information about commodity related currencies there, which we already opened up. During a risk-off event, dumping equities for bonds and another natural response. To get a broader view on the macro themes impact each currency and related markets, please take care. We're gonna open that up. Why not cover that? And that's pretty much it. So you can expect inflows, right, into thing currencies like the dollar, the yen, the Swiss franc, and such when, oh, and gold as well, when we are in a what environment? You can answer the question if you want to. Are these both the same? Yes, they are. Suppose that. All right. So in a what environment? Think about the definition of risk on, risk off. You're probably looking for yourself already. And then think about all the way down here where it says impact on forest matters. First and foremost, risk aversion can lead to liquidation and profit taking. The process of unwinding these trades may result in a need to buy back funding currencies like the dollar and the yen. So, in turn, the rest of the safe haven assets. When the above charts convey a sense of nervousness in the market, so when there's a sense of nervousness in the markets, they influence safe haven assets. Risk sensitive currencies will be kept in demand. So, when I say risk sensitive currencies, they mean the currencies that I mentioned. When they're signed times of certainty, they move to the other currencies. Pretty easy. So with the dollar down for the day and the dovish speech from last week, right? We have currently gold doing well and the dollar, for the week it's doing well, but for the day it's doing bad still down and continuing to drop for the day. So that means that for the week, the dollar is currently, let's see for the week. Let's see what the current updated for the week is right now. So it dropped all the way from up here down to 18. I believe the below the New Zealand dollar or at the New Zealand dollar, but definitely below the Australian dollar. So what does this reflect? If the dollar is dropping, and then I just explain this to you, what does this reflect, right? If they if they're if they are underwriting these trades, it may result in the need to buy back funding currencies like the dollar, when above convey a sense of nervousness in the market. That means there's less nervousness in the market. And they said these will be in demand, which means that these would be inflowed into by the investors during times of uncertainty, and these would be appreciating. But since that's not the case today, and for the week, because we've come down significantly from like 50, it being the leader for the day until not, and we have every other currency also dropping below. We got the Swiss franc and the yen also dropping below. That means they're moving their money from out of these risk sensitive currencies and into currencies like the New dollar, the Australian dollar, et cetera, et cetera, et cetera. Water break. And that's why the Dow Jones is doing well, because there's the interest rates cuts are doing what? Everyone's speculating that the interest rate cuts are going to be what? Exactly. The euro's doing bad compared to the dollar, consumer confidence and things like that, but the dollar is coming down now below the Zealand dollar. So they're outflowing out of the dollar and into the other risk sensitive currencies, out of the yen, out of the Swiss franc, et cetera, et cetera, et cetera. So let's cover this. Market sentiment. Understanding the trend and making it your friend. Market sentiment is defined as the net amount of any group of market players' optimism or pessimism reflected in any asset or market price at a particular time, a kind of collective emotion. The goal of understanding sentiment is to discern when the trend has reached an extreme point and is prone to reverse in its direction. Among sentiment indicators, there's the VIX, the COT report, put call ratios, the TED spread, mutual fund statistics, margin balances, and investor polls such as FX investor poll forecast, which I didn't know they had. Pretty cool. So open that up. See if they have anything else here. Nope, no. So that's how you understand market sentiment. Sentiment related content. So they show you sentiment related content as well. Where is the commodities one? All right, so why is New Zealand dollar commodity linked currency? What is it linked to? Let's see if they have it just like right down here. Okay, here it is. Yep. Commodity currencies are said to be correlated with the price of commodities. The Australian dollar, the Canadian dollar, and the New Zealand dollar are considered commodity currencies because the economy is backed by their named currencies are sensitive to commodity valuation. And it's like be sure to factor in the global economic outlook when evaluating any of the commodity currencies. In any case, correlation is not uh, causation, and their relationship can be can and do break down. So they are moving into commodity linked currencies, the CAD, New Zealand dollar, etc. And these are all going to be opposite correlation of the risk sensitive currencies. That's why they said that when people are inflowing into safe haven, then they assets, then these tends to do not do so well, and vice versa. Very interesting. The Australian dollar, being China a tremendous consumer of raw materials, Australia a leading exporter of metals, coal, and grains. This is why market perception of strong demand from China could see the Australian dollar gain in sympathy with commodity prices. The boom in Asian regional growth over the past decade has supported the Australian economy, bringing with it higher levels of inflation. This explains why the RBA, the Reserve Bank of Australia, maintained higher interest rates um, than other major central banks at the time. Let's go down. The CAD. Canada is the fifth largest gold producer and 14th largest oil producer. Thereby, strong commodity prices generally benefit domestic producers and increase their income from exports, which also in turn increases their GDP. Obviously, there's a caveat though that this is a positive correlation to make the Canadian dollar more expensive in USD terms. Since Canada's economy is very dependent on external demand from the United States, a strong CAD could filter into reduced demand for Canadian exports. New Zealand dollar, which is the one we came to look at really. But um, New Zealand dollar, New Zealand is primarily an agricultural commodity producing economy, dairy products and meat in particular, and therefore it displays a weaker correlation with the CAD and the Australian dollar to metal and energy prices, but still it's highly sensitive to global performance, especially of its key trading partners, Australia, United States, and Japan. Its commodity currency status is also to be understood via its dependency on the Australian economy. So you have China being the big bro, um, Australia being the second biggest bro, and then New Zealand dollar being the little bro, and they all affect each other and influence each other all the way down from the top down. Um, Whenever the let's just say China was in a position to hike rates right now, then the Australian dollar would be going up as well because we all know what hiking rates does. Its commodity currency status is also understood via its dependency on the Australian economy, since Australia is very commodity driven. Any changes affecting the Australian economy affect the New Zealand dollar as well. That in turn, anything is affecting the Australian economy, I'm not bad, the Chinese economy will affect Australia and then ripple down to the New Zealand dollar as well. I guess as you can see here in currency strength, they move together. They move together. You can see that the odd is up, and so is the New Zealand dollar. And any given day, on any given day, these guys are going to be like two brothers, always moving with each other. And you can see why. So, how bullish are commodity currencies against the US dollar? A bullish percentage compares to four majors, majors against the 21 most traded currencies. Among these currencies were the Korean won, the Mexican peso, and the Turkish lira. And try to make sure we're staying on task right here. Perfect. So to sum up, because that's pretty much the end of the article, to sum up risk on and risk off, right? One more time, because you can never hear this too many times. Risk aversion refers to when traders unload their positions in high yielding assets and move their funds in favor of safe haven currencies, right? This normally happens in times of uncertainty and high volatility, a so-called risk off environment. In turn, periods of perceived low financial risk encourage investors to take risks, therefore moving themselves out of safe haven assets and into these other currencies that I was referring to. Whenever the dollar is doing well and in a risk off environment and they're flowing into the dollar, and the yen is doing well and the Swiss franc is doing well because safe haven currencies are in demand, then they are going to be appreciating. And in terms of periods of low financial risk, encourage investors to take risk, therefore creating a risk on environment. And then the following instruments are good barometers of being able to do risk on and risk off. a measure of risk on and risk off, and also trade as well, obviously for risk on and risk off markets. So I'm showing you where the money goes, right? I'm trying to show you where the money is going and where the money goes. So let's do just real quick a physical example of risk on, risk off. Let's find some white space right here. Let's find some white space. Okay, so we have the US dollar, we have the Japanese yen, we have the Swiss franc, we have gold, right? And we'll just focus on, and then we have obviously risk on and risk off. I'm gonna make these bigger in a second. Risk on. I don't need to go over that definition again because you guys have already heard it a million times. And anything else you guys can actually just um study on your own. Honestly, after the information has been given to you, it's up to you to continue to study it. And we're gonna go risk off. Yeah, you'll forget the O. All right, risk off. And then we can duplicate this as well. And then go make this a bit bigger and make that like 22 or something like that. That's cool. And we'll be going by definition as well. We're going to refer back to this so that everybody, New Zealand dollar, the Canadian dollar tends to do well. We have the Australian dollar as well, obviously. Um, the euro also tends to do well whenever I'm going to put that just because the euro does appreciate, is in direct correlation with the dollar. And the euro always appreciates when the dollar is down. Just on some risk aversion stuff. Let's drop these. And like obviously, and we have a more continued drop. The euro has some catching up to do. We did have some negative news for the euro, but overall for the week, the dollar took a pretty nice plummet and is the loser for the day. So you can see the actual correlation: dollar down, euros up. Um, so I put the euro on there as well, and you can expect the euro to do well when. I'm going to make sure I'm not missing any. Let me just go look here. The pound is not as risk sensitive, but obviously, if we have the dollar down, the pound being a main economy, it automatically appreciates when the dollar is down. As you can see, it's still above the dollar, unless there was some type of heavy fundamental factor that affected the pound also. But still, overall, even if both are down in a risk sensitive environment, when the dollar is down, then the pound will still overall be doing better than the dollar, and that would still be a long. So let's make that a little bit bigger. We can make that like 18 or something like that. Both of them real quick. All right. So risk on, risk off, two sides of the equation. And then we will also do this as well real quick. Is that vertical line? Perfect. So risk on, risk off. And these are, we're going to put in the middle real quick, investor money. When they're inflowing their money. We can turn that one green. We can turn that one green real quick. Since money is green, and we put that in the middle. Perfect. So that's a really beautiful, left and right. Right. So these are going to be the easiest to trade, but especially the odd CAD and New Zealand dollar. These just automatically fluctuate opposite of the dollar depending on what happened. Most 9 times out of 10, because these are going to be two big economies that do business with the dollar and that are some of the biggest economies in the world. So they tend to do well. Like I said, when the dollar is down. One more time, just one more time on the definition. Risk aversion refers to when traders unload their positions in higher yielding assets and move their funds into favor of safe haven assets. Assets, not bad, or currencies. I call them assets. Some people call them currencies. It's fine. This normally happens sometimes when uncertainty and high volatility, a so-called risk-off environment. So we obviously right now, for the day, are not in a risk-off environment, given what the dollar is. In turns, periods of perceived low financial risk encourage investors to take risk, therefore creating a risk-on environment. The following instruments are excellent barometers of market sentiment and can indicate higher or lower yielding lower risk depending on their performance, right? They're telling you look on the chart and look at performance when we have indicators of events that happen that cause risk on and risk off. Like if you have more evidence of like the Fed this week needing to cut, let's say labor market data or whatever, then obviously it's going to create a risk on situation where investors are going to be continuing even harder to profit take on dollar longs and outflow out of the dollar. And in turn, these are going to be the dollar's going to continue to fall. So let's get back to where I was. I don't know how that even happened. So obviously, right now, it's not going to be, let's move this real quick. It's not going to be very favorable to um, buy the dollar given the drop. Just to let you know, we are indeed in a risk on environment currently at this time. I actually need to put this back down here and then just move this right here. So right now we are in a risk off environment. My bad. Risk on environment. People are moving their way out of the dollar, and the dollar is not doing so well. It dropped even more since the last time we looked. Um, so investors are moving their money out of the dollar and into these other currencies. If things do change in an instant, right? That's what they're doing right now. They're moving out of the dollar, out of the yen, out of the Swiss franc, which is why they're down for the day as well, and then move their money over here. Things can change though. They change their positions in an instant. Let's just say the dollar continue to prove that we're actually going to have to hike rates. The dollar's going to appreciate. Now that things are in demand, they're moving their money back into here. Let's just say 2 weeks from now, it changed again. Do you know what's going to happen? They're going to be like, just kidding. We're actually going to go over here and move our money here. And that causes these to appreciate and then these to appreciate and then drop in the outflow back and forth, like ping pong, honestly. So you can think of the um the investor money as like a very back and forth, risk on, risk off, risk on, risk off, risk on, risk off. And that's how the market money flows. Same thing with here. If I went to duplicate this and went to investor, um, went to what is it called? Prompt table, right? They also change their positions, right? The actual raw data of that. They also change their positions based on, risk off. Fundamentals um, developing create either risk on, risk off environments for a currency. Sometimes it takes a few months to develop. Sometimes it takes a few weeks. Sometimes one report is like really weighing because of previous reports. But currently, we have from last week to this week on the dollar, they actually decreased short positions. I do believe, like I said, long term, given the new narrative, this is the last time they're net positive, they're going to continue to exceed this negative 21 in the next coming weeks and continue to short the dollar given the new narrative, unless something develops that is going to be change that. So it's the same thing with these guys. All of these currencies here, they move their. This is why they show all these main currencies right here. These are the main big currencies right here. Um, risk on, risk off, risk on, risk off, etc. When it comes to things. So if like last week, for example, the Fed speech, right, and the fact that he hinted at dovishness created what type of environment? Which one? Risk on or risk off? If you look at the definition, and I say that they exactly. So with that being said, it gives you a bigger picture of where the money is actually flowing when these things happen. It's not just like, oh, fundamentals are this way or fundamentals are that way. It's about where the money is going as a result of that and having that like a little bit deeper understanding than just technicals to show that that is happening. So right now we're in a season of like getting ready to cut rates, and that's why the Nasdaq is doing well, and that's why the Dow especially is doing well, right? And that is specifically the policy of the Fed is going to affect the Dow. The policy of the Fed in terms of currencies affects either risk on or risk off markets, depending on if it is pointing towards a dovish or bearish, cutting and things like that, like sacrificing a labor economy, the things that I covered in the video about central banks and inflation and all those other things, or is it going to create a risk on or risk off environment, right? Which one is it going to create? Is Are there times of uncertainty right now? If so, boom, you know exactly where they're going. And then you can actually look, especially when I post the currency strength at the correlation, especially for the week, at the correlation of risk on, risk off environment and how the currency is doing. So you can pretty much use the US dollar as a good barometer for everybody else because everybody else is out goes, based off the US dollar. And if the US dollar is having inflows because of a certain risk environment, then the yen will also appreciate, and so will these other currencies. So it makes it pretty easy to kind of narrow down what even could be a risk on, risk off environment and what would even cause that, right? Is the current fundamentals supporting that currency going short or long? Is this fundamental development creating very uncertain times? Mixed data tends to create uncertainty, right? If you have, let's just say inflation kind of up and down and up and down each report, that's going to create uncertainty. No one knows where inflation is actually going. They might not, you know what I mean? They might change their risk aversion strategy and move their money elsewhere. So, with that being said, I hope I explained that well. This is the end of this video. Like things like this, Japanese yen gains on hawkish, and then there you have hawkish BOJ outlook. As you can see, um, the Japanese yen gained on the bank hawkish or bullish. They're going to hike rates. Bank of Japan outlook. Russia Ukraine peace hope might cap gains, right? And this is how geopolitics also affect. I don't think there's going to be a peace talk here, honestly, but we'll see. Japanese yen, but and it's like, how do you kind of put two plus two together and make it equal four right here? You have to continue reading these articles in context with what I said, right? And what I've just shown you. Japanese yen builds it on steady intraday ascent against a mildly negative dollar and touches a fresh daily top heading into European session Monday. This was yesterday. The Bank of Japan upwardly revised its inflation forecast at the end of the July meeting and left the door open for an imminent interest rate hike by the end of this year. This along with slight deterioration in global risk sentiment, which is exactly what we just discussed, drops from safe haven flows towards the JPY. And they're saying that their safe haven flows going towards the JPY because of these reasons, right? When they're hiking, they know that the yen's going to appreciate, and now they're moving their money into the yen. And sometimes it is that case where the dollar might be cutting, right? This is the divergent central bank policies. We have the Fed going dovish, and then we have the yen talking about hiking rates. We have one currency getting ready to go down and one currency getting ready to go up because of the reason stated, right? Creating a demand for the yen, and like current these risk sensitive currencies can have specific and individual demand by investors because of current fundamentals developing, creating a likely appreciation or for sure appreciation in the Japanese yen. What are you going to do? You're going to move your money to the yen, and you're going to invest your money into the yen and the Japanese yen economy while it's going up. And then when things turn sour again, you're going to move your money out of the yen. You're going to profit take on any longs you did on the yen, and then you're going to move your money elsewhere. And you're going to repeat that over and over and over and over again, and that's trading. Meanwhile, the Bank of Japan's hawkish outlook, and that's just like being able to see where the money is flowing. But you have to be able to understand this first. And I'm trying to give you some context here in terms of an article. Meanwhile, the Bank of Japan's hawkish outlook marks a significant divergence in comparison. Divergence as an opposite policy stance. Like I said, one is getting ready to cut and one is getting ready to hike with the current narrative. And these are from these officials from the Bank of Japan. These are from the officials of the latest development of the U.S. dollar. Meanwhile, the Bank of Japan's hawkish outlook marks a significant divergence in comparison to expectations that the Federal Reserve will resume its rate cutting cycle in September. This, in turn, acts as a headwind for the U.S. dollar and further benefits the lower yielding Japanese yen, leading to the USD-JPY pair's intraday pullback of around 50 pips. However, hopes for Russia and Ukraine peace deal might cap the Japanese yen amid uncertainty over the likely timing of the next BOJ hike. And here's some key points. Here's some key points for fundamentals, right? In the geopolitical front, so war, U.S. Donald Trump announced on Monday that he had begun preparations for a face-to-face meeting between Russia, Vladimir Putin, and Ukraine President Zelensky. Very, very pointless, honestly. This follow, I would be shocked if Zelensky just laid down and submitted. This followed a summit with Zelensky and the European leaders earlier in the day, fueling hopes for an early peace deal to end Europe's deadliest war in 80 years, and demand for safe haven assets, right? And this is why this is going to weigh on the yen potentially, but these are just headlines, right? No deal has actually been made. I like to trade what is actually happening, and I like to hear from Zelensky and Putin. Like oftentimes, Trump will say, "Oh, these things are happening," and then Putin will come out and say, "Oh, absolutely not," or somebody who represents Russia will be like, "That didn't happen," or Zelensky will be like, "Actually, we're actually like for example, last week." He tried to say he didn't give Zelensky permission to attack Russia that deep into Russia. And Zelensky had came out and said they've been using their own weapons lately, and that shows that Zelensky is realizing some stuff and removing dependency on the U.S. You know that it's bad, as I said last week, when you are willing to give yourself a disadvantage in the war back to basically where you were before, with now no first world technology weapons. That's pretty much the only thing that's been holding them up in this war at all. Otherwise, Europe would have, or my bad, Europe, Russia would have won last year very easily, given that they're like the second or third largest economy in the world, and they also don't have bad military tech. It's just not Americans. So they're telling you, hey, here's how geopolitics are affecting the yen because of the denting the demand for safe haven assets due to a talk about a meeting coming up, basically, and potential progress in peace talks. So peace talks, right? Whenever they're talking peace, whenever there's headlines about peace and meetings and coming up, it takes down the demand for safe haven assets, and then in turn it weighs on high safe haven assets like the dollar, which is obviously another thing weighing on the dollar, the Swiss franc, and everything like that. In general, safe haven assets tend to do bad when war is being solved, and they do well when war is happening. They move their money to safe haven assets when war is happening because it's times of uncertainty. It's either going to, you know what I mean? And they move their money away from safe haven assets. There's no demand for it via investors because there's a potential peace talk here, which is not going to materialize to anything. And once they do find out, it'll reverse itself. So that's a lot about risk sensitive currencies and how they affect it. Gold, I said, is a risk sensitive currency asset. I guess you can see it's not a currency, technically speaking. Mixed cues on gold, they're saying. So because the dollar is down and they have opposite correlations, there's demand for gold always when the dollar is down. When they're uncertain about the dollar, they move to gold. Retreating U.S. bond yields and Fed rate cut benefits the non-yielding yellow metal. So as I said, Fed rate cuts are bearish for a currency, and retreating U.S. bond yields are benefit gold. So all U.S. dollar negatives, they're benefiting the currency. I'm also used the uptick in positive risk tone by capping any meaningful gains for the commodity. And this was published 8/18. This is just an example article. Gold struggles to capitalize on goodish intraday recovery from 2 week lows touched earlier this Monday, and trades was modest. So at the time of writing, right, the modest uptick in the dollar would have capped any meaningful gains for gold, given that they have opposite correlation. Whenever, like I said, they are not liking the dollar because of uncertainty, they move their money to other safe yielding assets like gold. So because there's some demand for certain safe haven assets, right? Like gold and the yen, right? For certain reasons, like maybe the yen's hiking rate. So now the demand for that particular currency in terms of a safe haven asset is now up, or the US dollar is down and they have opposite correlations. So now gold, it has demand for a safe haven asset and will appreciate. And then obviously the geopolitics also affect gold. It's the same thing. Essentially the same thing in terms of how it affects gold when there's times of war and times of peace talks. Um, Notice how they're always talking about investors, the entire market, every article, investors this, investors that. Meanwhile, investors remain on edge ahead of U.S. President Trump's meeting with the Ukrainian president, and this is obviously like it's already happened. And European leaders to discuss a peace deal with Russia. Furthermore, the growing acceptance that the Fed will resume its rate cutting cycle in September might hold back the USD bulls. So from placing aggressive bets. So in a very particular case, you have the dollar getting ready, the Fed getting ready to cut rates, which is dampening and drawing back demand for the dollar specifically as a safe haven asset. So they're just like, we don't want to put our money in the dollar, let's put our money in gold. Let's put our money, get ready to long the yen because of the hike and things like that that's getting ready to come and things like that. Um, this might continue to offer some support for the long yen and gold and want some caution before positioning any meaningful downside. So that is another article example that happened, I think it was last week for gold. Obviously, this came into fruition because where is gold right now? Just on the daily time frame. What's gold doing right now on the daily time frame? It's going up and it's been going. It's been ranging, but there's been plenty of opportunities when current demand has happened. So right now, the story from last week has played into this week, right? The dollar's down for the day, the dollar's down, tumbling for the week overall from highs. The Fed interest rate cut and bets on that the Fed will actually cut rates is helping the helping the helping gold appreciate. Some investors are moving their money into this particular safe haven asset due to those reasons. And this is why it's important to read these articles in context with this risk aversion, risk on, risk off indicators and how that works, right? So that's why you need to learn fundamentals, right? That was just a lesson plus some examples plus some actual chart showing you the correlation of risk on, risk off versus what that currency actually right now at this moment is doing. I don't need to prove to you all day that this works and that fundamentals are what runs the market. I literally just showed you in reference to what I just explained. So that was risk on, risk off. Sorry about the video length, but like I don't like to cheat you guys when it comes to knowledge. I wanted to explain that in a way that made sense. I would highly recommend, honestly, taking these every single last one of these, right? Every single last one of these and bookmarking them, looking at them, studying them, and then correlating that with what's going on in the chart, looking at them, studying them, and then correlating that with what's going on in the chart. If I'm moving too fast, please screenshot it. Looking at this, studying this, getting this in your head, especially in reference to the things that you actually like to trade as well. But if you want to be able to trade these other currencies, this is what moves these currencies and these different asset classes as well. So that is a basic lesson on, risk off. Everything that happens in the market in terms of fundamentals either causes one of these two environments. So it allows you to really kind of like hone in on where the money is going, where the money is flowing based on events that are happening. And actually even explain to you more particular situations when certain safe haven demand currencies will be in demand, and while certainly other ones are not, just due to their policy and things like that. So the dollar might be down for the day or for the year going into 2026, but the yen might be up, the pound might be up, the euro might be up, just due to risk on, risk off indicators and medium to long term central bank policy. So you have to gauge the data coming out, figure out how it's affecting central bank policy, as I explained to you, and then and we'll go over like the more minor high impact reports. So actually, there wouldn't be minor like PMIs and things like that, and how they affect the actual currencies and things like that, and central bank policy. And then you can use this article to gauge that. If you have any questions, which I'm sure you will have questions, please send them about this video. I will see you in the next one.